can I just because I have a question for Mahdi, because I think you know, we're all looking at those not the fiscal cliff but the debt cliff, the 200 to 300 billion on the bank's balance sheet, where we say there's a shortage of funding. In your view, does that mean that the foreclosure on assets from banks is going to accelerate? Because right now what we've seen in this country is extension of loans, very, very little foreclosure. And so how do you think we're going to find this capital through other sources, or do you feel that this gap is going to end up on banks' balance sheet eventually, and then some sort of massive liquidation?
Thank you for the question. It's not an easy one. This is actually the one we've been scratching our heads about for the past 2 years. Well, maybe just I'll answer your question, and then I'll make a couple of comments about when I hear yields going down below 4, I tend to think when I was in the U.S. 2 weeks ago, and I was asking investors, why should you pay 3 to 3.5% for residential in the U.S. on the West Coast and East Coast, and for offices in New York? What is the rationale for that degree of massive yield compression? And the answer, most investors, is we expect growth. We expect NOI growth. We're paying NOI growth. And if you put the same question to investors in Europe, we want to preserve capital. That's the answer. So it's a completely different attitude towards yield compression. And I think that that links back to what Stéphane was saying. I'm not sure you protect your capital when you're buying that sort of yield, because you're probably not going to have a lot of rental income. You may have some indexation, but then how do you work out when you're overvalued, when you're over-rented? And then suddenly your valuer comes to you and says, oh, hey, by the way, I have to factor in the fact that bond yields have decompressed because France has lost its AAA rating. Now, going back to your question, I think we do meetings with our banks regularly, and this is a hotly debated subject. Some actually are saying that there's no funding gap. I don't think that's completely true. I think when you talk about foreclosure, I think the market clearing will be much easier in countries where foreclosure is easy and is implementable. That's the UK. I think it's much more difficult when you're talking about France. I mean, we have some recent examples about that. And then it becomes messy, it becomes lengthy, and it becomes cumbersome. And then you have to factor in some sort of discount and risk premium. And that factors in the whole market. So it may become, this is why I think there's a macro risk on France if you don't manage to do that. However, the banking system is in much better shape here than it is in other countries, and speaking of peripheral, of course. But going back to the example I was giving in the US, most of the vendors from our opportunistic funds were lenders or servicers. I don't see this happening yet, and that's going to take many years in Europe. But again, debt is an attractive proposal for life insurance companies today, as long as the margins stay where they are. And if there's one thing that the LTRO at the beginning of this year had as a consequence, is that banks were not really ready to take the hit on their books as yet. So we didn't see that much loan sales this year. I expect to see much more next year, and particularly with a lot of funds maturing. And I'm not only talking about closed-end funds. I'm also talking about some German open-ended funds, and I'm also talking about a lot of Italian funds will mature in the next 2 to 3 years, and will have a lot of assets to put on the market. So that, yeah, definitely that's going to play negatively on capital values.